Ever wondered how investment risk and taxation could be a game changer in your financial planning? It might be a question that has been nagging at the back of your mind, an unfamiliar territory that's often clouded with complexity and riddled with myriad questions. This world of investment risk and taxation may sometimes seem daunting, a complex labyrinth of percentages, figures, and laws that might have left you scratching your head more than once. Well, it doesn't have to be so. Imagine having the power to foresee these complications, those critical factors that can change the trajectory of your financial future. Imagine being more than just a spectator, but an active participant in shaping your financial destiny. The terrain of investment risk and taxation is indeed intricate, but not insurmountable. Let's delve into this often misunderstood area of financial planning. Investment risk. The chance that your invested capital could decrease in value. It's a crucial facet of financial planning that looms large over every decision we make. Meanwhile, taxation, that necessary evil, can have profound effects on the potential return of your investments. Therefore, understanding both these concepts is a fundamental step in your journey of financial planning. Knowing the nitty-gritty of investment risk will allow you to make informed decisions that will help you strike the perfect balance between risk and return. Similarly, a good understanding of taxation laws will ensure that you don't pay a penny more than what you're obliged to. Knowledge, as they say, is power. Power to make informed decisions. Power to strategically plan your investments. Power to turn the tables in your favor. So let's make it our mission to conquer this complex landscape. Together, we will decode the secrets, simplify the confusions, and set forth on a path of financial liberation. Well, ponder no longer. Welcome to a comprehensive guide that simplifies the complex world of investment risk and taxation. Before we dive into the nitty-gritty of risk and taxation, it's essential to understand the different types of investments available to us. Each investment type carries its unique set of risks and taxation rules, and it's crucial to comprehend these nuances to make informed investment decisions. Firstly, we have stocks. When you buy a stock, you're effectively buying a piece of the company. You become a shareholder, owning a fraction of the company's assets and earnings. Stocks are a great way to grow your wealth as they offer high returns, but remember, high returns come with high risk. If a company does well, your stocks increase in value, but if the company doesn't perform as expected, the value of your stocks can plummet. Next up, we have bonds. Unlike stocks, when you buy a bond, you're lending money to the issuer, which can be a company or government. In return, the issuer promises to pay you back the loan amount along with interest at specified intervals. Bonds are considered safer than stocks, with a lower risk of losing your initial investment. However, they also offer lower returns. We also have mutual funds. These are investment vehicles that pool money from numerous investors to invest in a diversified portfolio of stocks, bonds, and other securities. Mutual funds offer diversification, a key strategy to manage unsystematic risk, which we'll discuss later. Real estate is another popular type of investment. This involves buying property, such as land or buildings, with the hope that it will appreciate over time. Real estate can provide steady income through rentals or large profits through property appreciation. However, it's not without its risks, including property damage and market fluctuations. Finally, we have commodities. These are physical goods like gold, oil, or agricultural products. Investing in commodities is a way to hedge against inflation and market volatility. However, it's important to note that commodity prices can be highly volatile, influenced by global economic and political events. Understanding these investment types will help us better understand the risks and tax implications associated with each. So, keep these in mind as we delve deeper into the world of investment risk and taxation. After all, a well-informed investor is a successful investor. Let's continue on this journey of financial enlightenment. Next stop, investment risk. Let's dive right in, kicking off our discussion with the term investment risk. This phrase may seem daunting at first glance, but let's peel back the layers to reveal its true meaning. It's nothing more than a measure of uncertainty about the outcome of an investment, a way to quantify the unpredictability of financial outcomes. In its essence, Investment risk signifies the chance you're taking when you invest your capital. The chance that the returns on your investment might be different, perhaps less or even more than what you initially expected. Investment risk, therefore, is akin to gambling. You place a bet on a particular outcome, fully aware, or at least you should be, that the actual result might deviate from your expectations. Investment risk is typically categorized into two main types: systematic and unsystematic risk. Let's delve deeper into these categories to better understand them. Systematic risk, also known as market risk, is something that no investor, regardless of their prowess or experience, can control. It's an omnipresent risk that over the entire market, always influencing, always shifting. It's intimately linked to various macroeconomic factors such as inflation rates, political instability, and changes in interest rates. These factors are like the tides of an ocean, impacting all ships, big and small, that are sailing in it. For instance, a surge in inflation can devalue your investments, or an unexpected political event can send the market into a tailspin. These are risks that you can't eliminate or mitigate. They're part of the game of investing. On the flip side, there's unsystematic risk, or specific risk. This type is unique to a particular company or industry, much like an illness that affects only one person in a group. For instance, if a company experiences a sudden strike, it would affect its stock prices but not the overall market. Unsystematic risk is, therefore, a more localized form of risk. It's like a tree falling in a forest. It affects the immediate surroundings, but the rest of the forest remains untouched. It's crucial to remember that both types of risk can significantly impact your investment returns, but the way they influence your investments is different. Systematic risk can't be controlled or mitigated. It's a giant you can't slay. Unsystematic risk, on the other hand, can be managed through diversification. By spreading your investments across different companies and industries, you can dilute the impact of a single company's misfortunes on your portfolio. Remember, both types of risk can impact your investment returns, but diversification can help manage unsystematic risk. Now that we've discussed investment risk in general, let's delve deeper into the specific types of risk associated with investments. This knowledge will help us make informed decisions when investing our hard-earned money. Firstly, we have market risk. This is the risk of investments declining due to economic developments or other events that affect the entire market. The key factors that contribute to market risk include recessions, political turmoil, changes in interest rates, natural disasters, and terrorist attacks. Market risk affects the overall performance of the financial markets. For example, the global financial crisis of 2008 was a market risk event that affected almost every investor around the world. Next, there's credit risk. This is the risk that a government or company could default on its bonds, which means it can't pay back the principal or interest when it's due. Credit risk is directly related to the possibility of a company or government entity failing to fulfill their obligations to bondholders. For instance, if you own bonds in a company that declares bankruptcy, there's a risk you won't get your money back. Thirdly, we have inflation risk. This is the risk that the rate of inflation will exceed the investment return. In other words, the money you get back from your investment might not have as much buying power in the future due to inflation. For instance, if the annual inflation rate is 3% and your investment's return is 2%, you're effectively losing money because the cost of goods and services is increasing faster than your investment's growth. Lastly, there's liquidity risk. This is the risk of not being able to sell your investment at a fair price and get your money out when you need it. Certain types of investments, such as real estate or non-traded REITs, are more difficult to sell quickly than others, like stocks or bonds. Imagine needing to sell your house quickly because you need the money, but the real estate market is slow. That's liquidity risk. So these are the main types of investment risk: market risk, credit risk, inflation risk, and liquidity risk. Understanding these risks is crucial to making informed decisions about where to put your money. Remember, every investment comes with some level of risk, but by understanding the types of risk and how they can affect your investments, you can make better decisions and help protect your financial future. Moving on to the second part of our discussion, taxation. Taxation on investments is a topic that can seem complex, yet it's an incredibly important component that plays a key role in the overall financial planning process. The concept of taxation is often viewed as a maze, full of twists and turns that can be difficult to navigate. Nevertheless, it's a critical aspect of the financial world, and investors should have a thorough understanding of it. In the realm of the United Kingdom, we have three primary types of taxes on investments, which are quite different in their nature, each presenting its own set of nuances. These are income tax, capital gains tax, and inheritance tax. Income tax, as the name suggests, is levied on the income you receive from your investments. Such income can be in the form of dividends, interest, or any other return on investment. It's an obligation that you must meet based on the income you generate from your investments. Income tax is a progressive tax, meaning the tax rate increases as the taxable amount increases. The tax rate varies based on the amount of income you earn. The more you earn, the higher your tax rate. Capital gains. Tax is a different beast. It's not charged on the entire amount you receive from selling an asset, but is levied only on the profit or gain you accumulate when you sell an asset that has increased in value since it. This means that if you buy an asset and its value increases over time, you'll be liable to pay tax on the difference between the purchase price and the selling price, not on the total amount you receive from the sale. Capital gains tax applies to a wide range of assets such as real estate, stocks, and even certain types of personal possessions. It's important to note that not all assets are subject to capital gains tax, and there are exemptions and reliefs available that can reduce the amount of tax you need to pay. Lastly, comes the inheritance tax. This type of tax is a bit different as it's imposed on the estate of someone who's passed. The estate includes all the assets the deceased owned at the time of death, including any investments. If the total value of the estate, including any investments, exceeds the inheritance tax threshold, the estate may have to pay tax. It's crucial to point out that there are several ways to potentially reduce the inheritance tax bill, such as gifting assets or leaving a legacy to charity. So, to wrap up, these three types of taxes play a significant role in the world of investments in the UK. They each have their unique aspects and implications for investors. While they may seem like a labyrinth, with a little bit of understanding and foresight, one can navigate this maze effectively. Now that we've covered the basic types of taxes on investments, let's delve deeper to understand the various kinds of taxation. This will equip us with the knowledge to plan our investments better. Firstly, we have income tax. As we discussed earlier, this tax is levied on the income you receive from your investments. This could be dividends from shares, interest from bonds, or rental income from properties. By understanding how much tax you'll owe on your investment income, you can make more informed decisions about where to invest your money. Next, we have capital gains tax. This tax isn't charged on the entire amount you receive from selling an asset, but only on the profit or gain you accumulate when you sell an asset that has increased in value since you bought it. So, if you're considering selling an investment, it's crucial to factor in capital gains tax when calculating your potential returns. Then there's inheritance tax. This is a tax on the estate of someone who has passed away, which includes any investments they owned. If you're planning to leave your investments to your heirs, it's crucial to understand how inheritance tax could impact them. Now let's discuss property tax. This is a tax that's levied on real estate property owned by you. The tax is typically based on the value of the property. If you're considering investing in real estate, whether for rental income or for capital appreciation, you'll need to factor in property tax when calculating your potential returns. Lastly, we have commodity tax. This is a tax that's charged on commodities like gold, oil, and others. If you're considering investing in commodities, you'll need to understand how commodity tax could impact your returns. So to summarize, understanding the different types of taxes can help you make more informed decisions about where to invest your money. By considering the potential tax implications of each investment option, you can make better predictions about your potential returns and plan your investments accordingly. Now let's put it all together. Understanding investment risk helps you make informed decisions about where to put your money. It helps you balance your portfolio to maximize returns while mitigating risk. Understanding taxation on investments ensures you're not caught off guard when tax time rolls around. It allows you to plan for tax liabilities and potentially even reduce them through tax-efficient investing. In conclusion, investment risk and taxation are two critical aspects of financial planning. By understanding these elements, you can optimize your investment strategy and potentially increase your wealth over time. So, the next time you're contemplating an investment, remember to consider both the risk and the potential tax implications. It might just make the difference between an okay investment and a great one. Armed with knowledge about investments, risks, and taxes, let's now discuss the crucial next step: financial planning. Financial planning is the process of setting clear, measurable financial goals and creating strategies to achieve them. Firstly, it's essential to identify and set your financial objectives. These could range from saving for retirement, buying a house, or funding your child's education. Setting clear goals will help you focus your investment strategy and measure its success. Secondly, understand the effects of each investment on your potential returns. Diversify your portfolio to spread out risk and potentially increase overall returns. Remember, it's not about finding the perfect investment, but about finding the right mix of investments that align with your financial goals and risk tolerance. Thirdly, evaluate your comfort zone in taking on risk. This includes understanding your risk tolerance and risk capacity. The balance between these two aspects will determine how much risk you should take on with your investments. Fourthly, consider the tax implications of each investment option. As we discussed earlier, different investments have different tax implications. Understanding these can help you make more tax-efficient investment decisions and potentially increase your after-tax returns. Lastly, it's crucial to regularly review and adjust your financial plan. Your financial goals, risk tolerance, and tax circumstances may change over time, so your financial plan should be flexible enough to adapt to these changes. By following these steps, you can create a robust financial plan that takes into account both investment risks and taxation. Remember, a well-planned investment strategy is your best tool for building and preserving wealth. So, here's to making smart, informed financial decisions. Now that we've understood investment risks, taxes, and financial planning, let's move on to the next crucial step: portfolio construction. This is the process of selecting the right mix of assets to achieve your financial goals while considering your risk tolerance. Let's break it down into three key steps. Firstly, diversification. This is the practice of spreading your investments across a variety of assets to reduce risk. It's like the old saying, don't put all your eggs in one basket. By investing in different asset classes, sectors, and regions, you can protect yourself from significant losses if one investment performs poorly. Secondly, asset allocation. This is about deciding the proportion of different types of investments in your portfolio. It's about finding the right balance between stocks, bonds, real estate, and other investments. Your asset allocation should reflect your financial goals, risk tolerance, and time horizon. For instance, if you're young and saving for retirement, you might have a higher proportion of stocks in your portfolio because you have a longer time to recover from market downturns. On the other hand, if you're nearing retirement, you might have a higher proportion of bonds to preserve your capital. Thirdly, rebalancing. Over time, your portfolio's actual asset allocation will drift away from your desired allocation due to differing returns from different assets. To maintain your desired allocation, you'll need to rebalance your portfolio periodically. This usually involves selling investments that have performed well and buying more of those that have underperformed. Rebalancing helps ensure your portfolio continues to align with your investment objectives and risk tolerance. By carefully constructing your portfolio, you can manage risk, optimize returns, and achieve your financial goals. Remember, a well-diversified portfolio that's regularly reviewed and rebalanced can help you stay on track towards your financial objectives. So, let's get building.